Hi everyone, it's Jack about another video. Today I'm talking about Microsoft, doing a quick stock analysis, walking through my thoughts and feelings on this company and whether I think it is investable at today's prices. It's not had a great start to the year, down 25%, but everything's down this year pretty much. This is roughly in line with the S&P down, slightly worse. So it came down from $334, which was roughly its 52-week high at the start of the year, to $250, and it's bounced up a bit from its 52-week low. So these are some of the cheapest prices that might have been available for Microsoft in over a year. Its market cap is now 1.89 trillion, significantly down from where it was, well over the 2 trillion at one point, the most valuable public company. The PE ratio of 26 and a 0.98 dividend yield. Some attractive metrics, excellent balance sheet. Let's dive in. With the ubiquity and strength of the Microsoft Office package on Windows and Edge, it's easy to forget that Microsoft actually does a lot more than this, and many of its growth engines outside of this space. Microsoft Azure is clearly the key growth engine for this company going forward. Their cloud offering is growing at double digits a year, has incredible gross margin, and is really becoming the linchpin of this company, and there's definitely the growth engine. LinkedIn is doing surprisingly well, generating fantastic ad revenue, a great compound annual growth rate, considering this was a very, very poorly received acquisition when they bought it, and people were kind of not really having any idea why they were doing this. They also acquired GitHub, which has an excellent growth trajectory. Not to mention Xbox, which now has 25 million Game Pass subscribers. And PlayStation is soon copying them with the PlayStation Plus. They've soon transformed this business from a hardware business with getting some money on the side from the App Store essentially and the commission from games, to having a subscription service where they're getting a tremendous amount of high gross margin revenue on 25 million subscribers, and it's a fantastic value proposition for customers. On the topic of Game Pass, the latest acquisition at Activision Blizzard, which is sure to add a number of games to Game Pass and be a fantastic boon and increase in value for Xbox subscribers. The Competition and Markets Authority are investigating this anticipated merger, which is over $60 billion, a huge deal, Microsoft's biggest acquisition ever, and its deadline is due for the first decision of the first phase, September the 1st, 2022. I'm not expecting any real problems here. What it will be is that Microsoft have to say that these games, Call of Duty for example, are not PlayStation exclusive. They have to, or Xbox exclusive, and they're available for PlayStation. They will have to provide proof of this, that this is the plan going forward, and that they are not locking these down to each console, which I believe they will do, and they'll be amenable to this. So I don't see any real problems coming forward, and I think this deal will go ahead and is excellent for Microsoft. Looking at how the business performed in the most recent quarter, absolutely excellent results. 17% growth in the productivity and business process segment, 26% growth in the intelligent cloud, and 11% growth in more personal computing, which may just have the worst name for any segment of all time. For overall, 18% revenue growth and 19% operating margin growth. Both excellent numbers. Net income grew 8% because of some increased costs, for diluted earnings per share going up 9%. Overall, for the size and scale of this business, these are still pretty excellent results, considering this business trades at 25 PE, going up in the mid-teens with a decent gross margin. Is pretty good if you ask me. A 68% gross margin for this type of company across many business segments, some of which are not making a tremendous amount of money, is absolutely excellent in my opinion. Breaking these business segments down a little further, you can see the only one that didn't improve year over year was Office commercial products revenue. This is likely because it's being cannibalized by the cloud business. Many of these are in the teens percentages and above. LinkedIn revenue up 34%, Microsoft Azure and other cloud services revenue up 46%, cloud revenue 32%. These are all major drivers of the company going forward. On a constant currency basis, some of these even stronger. Azure up 49% year over year. Excellent numbers for an excellent business, and you can see across many product categories they're increasing dramatically. So we've seen that the business is performing excellently and is growing strength on strength. So what about the valuation? Well, it currently has a price earnings ratio of 26 on a trailing basis and on 23.5 on a forward basis. Not particularly impressive numbers for Microsoft's history, right about the medium where we expected. So this seems like a reasonable valuation versus Microsoft's historical valuation. Interestingly, a PEG ratio of about 1.25, very strong value for Microsoft history because it's predicted it will have strong revenue and earnings growth in the future. However, this is not bargain territory by any means. I would expect something to be below 1, maybe even below 0.8 to be bargain territory. This is just okay value in my opinion. Price free cash flow, a bit more concerning. 30 times free cash flow is it's expensive. This is far above the S&P 500 averages. While operating cash flow is a bit lower at 22 times, these are still expensive values and above S&P 500 averages. As is the PE ratio, 23.5 is far above the S&P 500 averages at the minute, which on a forward basis are around 15. Of course, this is not an average company. This is a far above average company of the S&P 500, growing at 18% a year with nearly 70% gross margin. But of course, you are paying for a premium for this. Looking at some balance sheet and profitability metrics, on the left hand side, cash to debt ratio of 1.17, not overly impressive for the industry, and actually very weak versus Microsoft history. But of course, they have been spending a bit of money, and the debt has remained largely the same, if not decreasing, since around 2018. But they have 120 billion or above in cash on the balance sheet. I'm not overly concerned about this at all. They have a AAA credit rating from Standard & Poor's. That's better than the United States government. Only Johnson & Johnson even has a comparable one. Their equity to asset of 0.47 is decent. Debt to equity of 0.38 is decent. Debt to EBITDA of 0.62 is decent. Interest coverage, very, very impressive. 38.65, meaning this year's EBITDA can cover 38 years of their interest payments, indicating that this is very low interest debt. And all of this combined together with an ultimate score of 8.2 shows that this is clearly stating the obvious, really. This is not a company at immediate risk of financial distress. Looking at the margin and profitability side, gross margin of nearly 69%, very, very impressive. Of course, the industry is the SaaS industry, so this is not the best you'll ever see. But at this scale, across this number of businesses, this is an excellent gross margin, especially just because of the revenue purely. When you're doing $50 million in revenue quarterly, this is going to be an excellent amount of profits. 42% operating margin, again excellent. 37.63% net margin, absolutely fantastic. Taking home nearly $38 or 38 cents per dollar of earnings. Return on equity percentage of 48%, outstanding. Return on assets percentage of nearly 22%, absolutely outstanding. And return on invested capital of 32%, really topping it off, the icing on the cake, absolutely outstanding. This is a company with an excellent track record of performance, of investing in the business and giving excellent results to shareholders, and long may this continue. Just to further illustrate the debt and cash on Microsoft books and why I'm not at all concerned about this, it has just over $60 billion in debt. Of course, this is a nearly $2 trillion company, so it's an incredibly small percentage of its equity. Not to mention it has over $120 billion in cash on the balance sheet, so I'm not at all concerned about this. While debt has climbed over time because they've made a number of acquisitions, it's been steadily declining since around 2017, and cash has remained largely the same because they do a lot of share buybacks, they pay a dividend, and they're acquisitive, so I'm not worried about this at all. This balance sheet is in excellent shape, and as again I mentioned, they have a AAA credit rating from Standard & Poor's. Finally, of course, is a discounted cash flow analysis to work out an intrinsic valuation for this business based on the sum of its future cash flows. Now, for this company to be fair value, it requires a growth rate of free cash flow of 17% over the next 10 years. Now, this is certainly possible. Over the last 5 years, they've averaged 17.5%, which has trended upwards from an 8.8% over the last 10 years, and they recorded 19.4% growth this year. Of course, growing at nearly 20% a year for 10 years, the free cash flow number would be truly enormous in 10 years. Now, it's certainly possible. Of course, we're potentially going into a recession, so you would expect this to come down slightly because many of Microsoft's services are pretty much essential. Azure is essential to many businesses. Microsoft Office is, of course, essential. It's not exactly something you can skimp on. However, I believe that 17% might be a little bit too much for this company to average over the next 10 years. Of course, I could be wrong here, but I think with this, I think the fair value is probably a little bit below this. I think that in truth, it's going to be overvalued in today's stock price. And of course, the upside is limited due to this being a nearly $2 trillion company. It's unlikely to 10x for a very long time. That would make it like the size of bigger than many countries. So I don't believe this is going to 10x anytime soon. I think it'll be a long time. Of course, you could beat the market with this company over the longer term. And I think absolutely this is possible. And I also think this is not a ridiculous time to buy Microsoft. However, I definitely think the price could come down a bit further if we go into recession. I think that'll be a more sensible time to buy when the valuation comes down a bit, because I just don't believe 23 times earnings is the best price for Microsoft. And I don't believe this is a proper fair value, because I truly don't believe that they can continue growing at 17% uninterrupted for 10 years. Of course, this is just my opinion. You should let me know in the comments what you think. Microsoft is, of course, an excellent business, and I'm sure what many of you are going to say. Let me know what you think about the price today. Let me know if you think it's a buy, sell, or a hold. Like and subscribe if you're enjoying the videos. I'll see you again next time.